Hey, good afternoon, everybody. And now I know why you all came here. Talk taxes, right? It's not the barbecue, the great weather, the great staff here, the great team, but to talk taxes. But we are, thank you very much. We're very honored to speak with you today. I'm just going to set my clock because I can go on for, oh gosh, about 8 hours regarding tax reform, taxes. But today's a special presentation because we're going to solve the problem that most of you are thinking is, okay, if I add to my portfolio, what is that going to mean to me tax-wise? So I thought, because we're so honored to be asked back to another event here, what can we do to make this hit home for everyone sitting in this room? And my goal is to have a conversation, leave room for some questions, and I want you to walk away all as either real estate investors right now or potential real estate investors with at least 3 to 4 practical tips that you can and takeaways. So I know that many of you have traveled from far and wide to be here, and I appreciate that. So we're gonna do a quick introduction, and then we're going to talk about a portfolio case study. We're going to look at 3 properties that were, as of February, actual properties for sale. And they probably are in someone's portfolio by now, but we looked at those properties and put some numbers to them. Sean talked a lot about the numbers, and so some of the slides I'm going to show you will look a little familiar. We're going to look at some tax planning consideration and tips, and then again, I'm going to open it up for questions. So we also are going to be myself and Peter Crane, who's here. He's a gentleman here in the second row. When I keep saying we're going to be here overnight and attending the barbecue festival. So if you have a question or something you maybe don't want to air personally, as long as we're not on our second beer, I think my advice would be pretty good. But, you know, we're happy to do that. So. Or if you just, like I said, come up to us or leave your card up here. We're not going to badger you, but we're happy to send this presentation out to you and talk about your questions. So I love real estate. My advice to many CPAs out there that are struggling with growing their practice and enjoying their work is, I say, why don't you write down your 3 hobbies and then just go find clients that share those hobbies. Because if you're doing the work in those fields, you're going to love it. So I love real estate, I love athletics, and I love music. So we are based in Nashville. We work a lot with real estate investors, entrepreneurs, professional musicians, and people in athletics. So, but anyway, so it's great because I always learn more from you than we end up spreading any word to you guys. So I've been doing this stuff for a long time. That's what that slide says. So we'll just move forward from that. So what are the assumptions? So we're going to build a case study for you. We're going to look at 3 different properties. Again, these are properties that were for sale as of February, and we're going to have to make some assumptions. You guys all come from different tax rates, different states. So I'm going to use an assumption that your marginal tax rate is 25%. We can adjust that up or down based on your scenario. The financials are based on the projections. Again, Sean went through a lot of projections for you. Then those are going to look familiar. We're going to assume the property was owned for an entire year because we're calculating some depreciation, mortgage interest, rental income, but assume the properties are all owned for a year. We're going to assume your losses are deductible. Now that can in some ways be a large assumption, and that's something we're going to talk about at the end of the presentation because there are specific rules for real estate investors as far as can they deduct their losses from rental activities. There are new rules with tax reform. Tax reform is the biggest change to our tax code since 1986. 1986, my Detroit Tigers were actually a good team and I had a nice head of hair. I know this because I saw my middle school yearbook at my parents' house when they just moved. They still live, I'm originally from the Detroit area. So assume losses are deductible. Some new things came out with tax reform that could really affect all of you as far as passive activity rules, as far as the Section 199A deduction, which we're going to talk about a little bit, and some especially new rules if you have short-term rental properties. which would include properties that the average stay is less than 7 days. Does anyone have any short-term rental property, or aka Airbnb type properties? Okay, well there's some new rules out there, but I'll gloss over those. But if you tend to be asking for a friend, and also if you're asking for a friend, that's okay, I get it. It's not you, it's me. And we're going to talk a little bit about cost segregation studies today and how they could affect your tax return and how they can affect your return on investment. I'm not advocating a cost segregation study on every return. That's something that we look at, and we either work with a strategic partner or we can provide that in-house. But again, these are just opportunities, and we have to determine if a cost segregation study makes sense. These are the 3 properties we looked at. These are the financials. Again, Sean ran you through that. I just want you to see where all of my numbers are going to be coming from based on what we're going to look at next. So we've got 3 properties, different price points. This one was under contract, so it's probably already rented out now. This is back in February. So these are the properties that we're talking about. So we took the 3 properties, we took the portfolio, and we built 3 cases. Our first case is what I'm going to call the with mortgage case, the leverage case. And we're going to make the assumptions based on, I'm going to back it up here, based on a 20% down payment and based on the mortgage terms that were outlined in these portfolios. And we assume that this property, you have mortgages on all 3 properties. And what we're looking at from a tax perspective is, okay, let's look at what the acquisition cost is, the rental income, and we break it down to taxable income. Now what we added to this is we said, all right, taxable income, what would the income tax be on that taxable income based on a 25% rate? And also, so what type of depreciation deduction will you receive for those properties? And what are your principal payments? So we took the taxable income and reconciled that to your net cash flow. So in this example, if you bought these 3 properties, your net cash flow would be $7,208, and your taxable income $615. So there aren't that many businesses that your net cash flow could be 11 times your taxable income. It's a pretty good gig, right? And on this example, just taking a step back, if you look at your cash on cash return, assuming you put $20,000 down, so that's going to be about $64,000, and you have a net cash flow of $7,200, you're at over 11% cash on cash the first, this year, assuming you owned it all year. So I'm not advocating getting a mortgage on all these. I'm not saying don't get a mortgage on all these. The way I looked at this presentation is, and I said, what do our clients ask us all the time? The calls I get every week, the emails, the calls, the consultations we conduct. Most of them are over the phone, and a lot of times I just took a lot of the worksheets I already do for our clients and grabbed, I wish I could say I would put like hundreds of hours into this, but I took all my practical experience and what we talk about with clients and threw it in here, and then we talk to the clients. Some people are more comfortable with debt. Some people are not comfortable with debt. But with this case study, you could see again, net cash flow is 11 times your taxable income. That's a pretty good gig. And so we said, okay, well, let's take the same case and let's assume, I'm going to call this my Daddy Warbucks case. You have no mortgage, all right? We're also assuming you're purchasing these, I should have put that in there, you're not purchasing these in any type of self-directed IRA or qualified, self-directed solo K plan. So if you had no mortgage, check this out. Your taxable income would be about $15,000. Your net cash flow, $21,259. I will say this. I know I'm throwing a lot at you. I'm very happy, if you don't already, to email you this entire PowerPoint. So, no worries. So again, this is assuming a 25% marginal tax rate. There's a lot of practical considerations we have to put into these decisions with our clients. But with this situation, your net cash flow would significantly increase. I'm going to back up by $14,000. Your taxable income would increase by about the same because you don't have the mortgage deduction. you'd still get the depreciation deduction, and your net cash on cash return here, what came out to 6.65%. So assuming you put down $319,500, your net cash is $21,259. I wish I had a fancy algorithm for that, but those are the numbers. So that's what happens if you take the mortgage off of it. Now, so sometimes when we're working with clients that really are not good with debt, but they do want the deductions, one of the strategies we can use is implement a cost segregation study. With the Tax Reform Act, it provided a huge tax benefit for cost segregations. And let me ask a real quick show of hands, and you might want to close your eyes because you got that good practice when we were thinking about our good mental habits, but how many people have heard of a cost segregation study? Okay, so what a cost segregation study is when you buy a property, a residential property, any of the acquisition costs minus land is deducted over a 27.5-year period on a straight line basis. So that's a long time for you to recapture your investment as a deduction. Now, you should feel good that you have an investment in the United States because there are several countries that do not get a depreciation deduction on their tax return. So if you purchase a property for $107,000, your depreciation deduction is $127.5 of that, $3,400. If you are a younger investor, or if you expect your taxable income to significantly increase in the future, you might be okay not taking immediate deductions. But the theory for most investors that we work with is one in the hand's better than two in the bush, and I'd rather have some positive cash flow to continue to reinvest into my portfolio. So that's what happens when you again acquire. It's 27.5-year straight line. What cost segregation does is it says, all right, we're going to allow you to segregate out the costs of any personal property in the real property. Like, okay, it's Friday afternoon, I'm an hour and a half away from barbecue and a cold beer. What's this guy talking about? Well, that would include lighting. It actually includes some roofing, electrical, windows, flooring, driveway, landscaping. All right, that's a lot. So if you were buying a pre-rehab property and then you were keeping track of all the costs, you could do your own cost segregation study. But what happens when you have a new property and you want to segregate out the costs? Well, if you have a cost segregation study performed, typically, rule of thumb, about 25% of the costs of that property are going to be personal in nature and eligible for depreciation deduction quicker than the 27.5 years. They fall into different buckets. Some are 5, some are 7, some are 15 years. So before tax reform, that was still a pretty good gig, right? Hey, we could write off the windows in 7 years and the electrical in 7 years. Well, with tax reform, what happened was any personal property that has a useful life according to the Internal Revenue Service of 20 years or less now gets something called bonus depreciation. So on January 1st, 2018, when you guys hopefully were toasting and getting ready for the Rose Bowl or something cool, us accountants were thinking, all right, let's see here, what's a 5-year asset and what clients might be able to benefit from that? And that's just our sad existence. But anyway, but the reality is you bought a property like this property right here in 2019, and you did a cost segregation study on this, you could most likely deduct $25,000 immediately first year, because that's the personal property percentage. If you have other properties, commercial property, if you have property that you've owned for like 8 years, and I'll tell you, commercial property is another one. That's a 39.5-year useful life. If you've owned commercial property for 10 years and it's worth, let's say $500,000 or more acquisition cost, a cost segregation study, you can come in and you can actually pretend like you did. It's like the get out of jail free card Monopoly. You can pretend that you did the cost seg study 8 years ago, and whatever depreciation you should have taken, you get in a one-time, it's called a 489A adjustment. You get it in one shot. Now, does that make sense for everyone? No, because if you sell that property, guess what? That all gets added back in your income, right? But I had a client that sold in our Orlando office. He luckily bought a bunch of property near an interstate by Disneyland, and they're like linking up the airport, and they're trying to do this this rail from Orlando to Miami, whatever. He got paid a lot of money. We did a cost seg on another piece of commercial property and picked up $700,000 one-time deduction, and he was pretty happy. So the point is I don't expect that everyone walk away and know when a cost seg study is appropriate, but understand what questions to ask of your CPA and figure out if that makes sense in your situation. So let's go back to Daddy Warbucks here. Mr. Cashflow and Mrs. Cashflow. They don't want debt, but they don't really like these ratios. They're not as like sexy as the 1 to 11, right? Okay, well, why don't we run a cost segregation study on a couple properties? Cost of the cost segregation study on a single family home such as these is around $1,000. It is a tax deduction, but let's run it. What happens? Approximately 25% of the acquisition costs are immediately deductible year one. What happens to your cash flow? I'm going to go back. Plus $11,000 cash flow. And what happens to your taxable income? You have a loss, which, assuming you can deduct it, which we're going to talk about that in a minute, you now have a $7,000 tax benefit. So now all of a sudden, if you paid cash into the cost segregation study, you're back to over a 10% return on investment, cash on cash, the first year. It's a pretty good gig. There's no limit to how many of these you can do. We have to think practically, but if you had 10 properties, some clients do one a year. It just depends on what your strategy is. So this cost segregation study. I wanted to throw that in there because we use this tool for clients that are a little bit less likely or don't have the appetite for debt. You can do a cost segregation study. I'm going to back up. If you do have a mortgage on the property, but we're already at a point where we basically have no taxable income, so I'm not that worried about getting rid of additional taxable income. So those are the three cases, and that's just an example of one tool that we use with clients. One more thing on the cost segregation study. A lot of times our clients like to get tax extensions. Now, before you start throwing things at me, because unfortunately people think a tax extension is a bad thing, when you extend your tax return, it does provide you with additional time to do things, such as cost segregation studies, make SEP contributions, make certain retirement plan contributions. So there are reasons you might want to do a segregate or extend your tax return to allow for you to do post-year planning. It's better to do pre-year-end planning, but that's just an example of something that you might want to do. So we're going to talk the best part, the juicy part of this presentation, practical tax planning tips. All right. First one I alluded to, the Section 199A deduction, also known as QBI. What the heck is this guy talking about? Section 199A was God's gift to the American taxpayer if you are self-employed. What Section 199A did is the corporate tax rate, went from 35% to 21%. Not a bad gig, right? Well, to even things out so that everyone just didn't form corporations and retain their earnings there, the Congress said we need to reduce the tax rate for business owners, and so we have to create the Section 199A deduction, which provides you with up to a 20% additional federal deduction based on the net profit of your business. There are some limitations when it comes to something called a specialized service business. That's why I'm going to stop right there, because we're not going to talk about that because I don't want to go on a tangent about that. But there are some limitations. But for purposes of rental property and owning rental real estate, all right, Section 199 does apply. So in theory it applies if you have rental income, net rental income, okay? There was a question posed that, well, is owning rental property a business? Does it qualify under Section 162 as a business? And the answer is, every client said, well, is it going to help me? Yeah, it's a business. Okay, fine. Well, the government said, well, that's, we don't know how we feel about that. So we're going to create some new safe harbor rules that basically say, if you fall under these categories, we're going to honor the Section 199A deduction. In other words, if you have net rental income and you're sitting in this room right now, and you are entitled to an additional 20% federal deduction, and how you do that, or the best way to do it, would be to make a safe harbor tax election. So it's a technical thing that occurs on your tax return. So one of my takeaways would be, if you did have net rental income, so if you were case number 2 in this situation that we went through, you should get the Section 199A deduction. So how do you elect the safe harbor? Well, you have to attach that separately to your tax form on top of the e-file form. I didn't want to take the chance of memorizing this, but essentially you have to put 250 more hours a year into your rental services to be considered a rental enterprise. You're thinking 250, that's 5 hours a week. I don't know, that might be tough. But here's the good part. The 250 hours is yourself and any contractors or subcontractors you're using. So you can include the hours that your property manager is putting into managing your property in that 250-hour calculation. So many of our clients do qualify for the safe harbor, and we made that election for them to get the extra 20% deduction. Also, that property couldn't be used as a personal residence throughout the year. There are some limitations, but the big limitation is the 250 hours. We want to avoid passive activity losses. Okay, in general, we talked about that we're assuming in our calculations that losses are deductible. But in general, owning rental property is a passive activity. I would bet that almost everyone in this room could prove that they have active participation in rental properties. So when we talk about avoiding passive activity losses, we have to think about your income thresholds, if you have material participation, or if you could be considered a real estate professional. So for some people, if they really aren't that actively involved in rentals, they have a loss and their income is more than $150,000, they don't get to deduct the loss. They have what's called a passive activity loss carry forward. We want to avoid that, unless it helps you, which that's another session. But let's assume so if you have material participation in general, you can deduct up to $25,000 a year in rental losses. And if you're a real estate professional designation, then you can deduct more than $25,000. So in general, the real estate designation is going to be 750 hours a year minimum, and it's your primary activity. So you spend more than you're not like jumping out of a cake 1,000 hours a year, icing yourself down, and doing real estate for 750. This tip is huge. The de minimis safe harbor election. Yeah, I know this one got fancy because there's a little lantern in there. This rule came out a few years ago that basically the IRS said, we're kind of sick of you guys doinking around with these repairs and maintenance and capitalization. If you have any line item under $2,500, you can automatically deduct it on your tax return. No questions asked. All you need to do is attach this de minimis safe harbor election. So when you're going to go to the barbecue fest, you're going to go to Beale Street, you're going to have a daiquiri, you're going to go back to your room, and then you're going to open up your tax return tonight. And you're going to say, did I make the de minimis safe harbor election or not? Hopefully you did. So anyway, anything under $2,500 is automatically deductible line item. So before, there were different rules. Now, I am going to say something on a planning perspective. I have several clients that own a lot of real estate, and they're concerned about their bankability and lendability. So if we're going to deduct a $2,200 window repair, that's great, but when it comes to a bankability, lendability perspective, a lot of times that's not going to get added back to your income. And many of you know what I'm talking about, and the lenders would be better to talk about that. So what we might do now with tax reform is we might capitalize that, even though we could deduct it, and just take the bonus depreciation. So it's the net the same effect, because we know the lenders are going to add back depreciation. So when they're looking at your cash flow. If you're Daddy Warbucks taxpayer and you don't worry about lending, I'm going to do the deduct it all day long. the repair. I'm going to go back to on the safe harbor election. The only other thing to consider is, like, in the state of Tennessee, we have a franchise tax if you have an LLC, and the bonus depreciation is an add back. So you have to be really careful and make sure your state and local tax considerations are thought of, and you have to figure out if your state is a tax reform compliant state. So are they going to allow the bonus depreciation? Are they going to allow? So and that again, that comes down to understanding what the client, what their objective is, and if I know someone's growing their portfolio, I'm going to capitalize more things than I normally would because I know it's an add back for lending. Rental grouping election. We talked a little bit about the passive activity rules, income thresholds. This one I want you to, after you check if you made the de minimis safe harbor, your eyes might be just a little like this. Check if you have multiple properties. Make sure you made a rental grouping election. That's really important because we talked about that past active participation, and you have to have at least, let's say 250 hours to get this one election and 700. I don't want you to worry about how many hours you're putting into the activities right now. But what's most important is if you have 5 properties, I don't want you to have to prove you have 250 hours in each property. That's almost impossible when you have 10 properties. So what you want to do is make a grouping election that basically says, hey IRS, I'm grouping all 10 of my properties, and I'm considering that one activity when you start counting my hours and you start counting my active participation. That's huge, very important. Especially, I would say 3 properties or more, it's essential. So we make rental grouping elections on almost all of our client tax returns where we're doing rental properties. 10T election, this is if anyone is using some advanced strategies such as using first position HELOCs on your primary residence to build your portfolio, even using second position HELOCs on your primary to build your portfolio, you want to take a look at the 10T election. Because especially with tax reform, the standard deduction went up to $24,000. If you are using money backed by your primary residence to buy rental properties, we want to deduct that on Schedule E, not Schedule A. So we want that as a rental deduction, not a personal deduction that you might not even be able to use. Well, how do you do that because of the IRS, now these mortgage statements, it says what property secures it, the mortgage, what's the balance, what's the interest. So if you want to use that interest from your primary home and you legitimately use those funds to buy investment property, you want to make a 10T election. Save this election lookup on your return till tomorrow, because we're getting really in the weeds now. But that's a really great tip. So if you haven't done that, don't worry about it. I already touched on state tax considerations. So again, everyone, you have to consider what state you live in, what state you invest in properties. We talked a little bit about entity selection back at the geek table over there. And that's something to consider. Every state looks at LLCs differently, or corporations, or living trusts. Just make sure you're consulting someone and considering what entity you're going to purchase these properties in. There isn't one size fits all, but that plays a role. And a lot of these tax planning tips play a role with each other as far as the bonus depreciation. And then we talked about cost segregation studies. Again, that could be an 8-hour presentation on its own. And guess what? We have a brave person with their hand up, so that's why I'm going to click to questions. Yes, sir.
What is the documentation requirements for real estate professional designation?
Okay, the question is, are the documentation requirements for a qualified real estate professional? 700. I'm going to tell you that it's 750 hours, and it's your primary duties. The IRS didn't come out and say this is what you have to have. What I would recommend would be using some type of Outlook calendar, Google Calendar. Essentially, you need a log of your activities. But here's the deal. I can't remember what I did yesterday. But my Outlook does, and my MileIQ app does. So you can go back and basically create it from looking at your calendar, your MileIQ. You're going to know where you went, who you met with.
This is only upon audit, right? This is only to defend. Right?
Exactly, upon audit, and those are going down. Yes, sir.
So the 750 hour, when she retires, and then eventually when I retire, it's really easy then to, as long as we document it, to certify that we're real estate professionals, which qualifies us for full deduction of losses.
For losses, correct. So this really pertains if you have losses in excess of $25,000, which you could on the rental real estate side. So I'll give you an example. If you retire, sometimes clients say, hey, I want to do a big Roth conversion. I'm retired. I want to convert but I'm going to pick up $100,000 worth of income. What can I do to offset it?
Sure.
So those are some of the tools the planning tools that you can use. So yes, I think we had yes.
This is a great presentation.
Oh,
Thank you so much.
Thank you.
So,
I'll leave now. No, just
Don't do it. George Costanza. If someone has, they are not a real estate professional,
Mhm.
and their mortgage gets them to zero taxable income,
Mhm.
is there any opportunity to use segregated deductions against my W-2 income?
Yes, there are potentially, depending on your income threshold. Mhm.
Very cool.
And here's another thought. Just let's say you have two properties. Let's say you might, and you know you're going to, one's under contract for the next year. You might want to do the seg study on the other one to create that's where I said the passive activity loss might help you. So it's all about, sometimes you're shifting deductions from one year forward to offset future income. Sometimes we're accelerating deductions because we have current income. So you might want to do a cost seg study, accept the passive activity loss, and then when you sell that second property, guess what? You have that passive activity. So you essentially took the deductions from one property you're keeping and pushed it to the property you're selling. Or you could do, we didn't even get into 1031 exchanges, qualified opportunity zone funds. There's like so much stuff we could talk about. So come and see Peter and I. We'll give you a card. We won't harass you. And if you just leave your card or give us your information, again, we'll email this to you. And as long as you reply and say you're at this event, we'll talk complimentary initial consult, and we'll look at your tax return, no obligations. We got a lot of work to do, but we love meeting new people. Yes? All right, well, thank you guys. Thanks. I'll leave a card up here, and again, just let me know if you want to chat.